Good evening. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to structure a FHA 203K renovation loan. Definitely a tricky loan to do. Let me tell you, I did one myself. It's definitely tricky. We'll get into that here in just a moment. Just give us a second here to go live on all the different platforms. Thank you, everybody, for tuning in nice and early. You can go ahead and drop a comment there in the chat. We got the chat up on the screen, so go ahead and drop a comment there. We appreciate it. Hope everybody's been having a great day so far and ready to learn some great stuff here this evening. So it looks like we're live on all the different platforms, so let's go ahead and get it started here. Keep dropping comments there in the chat. Drop any questions you have in the chat as well. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans, and what we do every Tuesday and Wednesday evening at 7 p.m. Eastern time on this show is do a new in-depth loan officer training. Tonight, we're going to be talking about how to structure a FHA 203K renovation loan. A lot of ins and outs of this. Definitely something to be aware of. It's an amazing option to have, but there's definitely a lot going on. As I said, I did one myself, and it was quite the ordeal. And I don't think I would do it again, but it's definitely a great tool to be used when necessary, but it's something you definitely need to be educated on. So our sales manager, Jose, with 28 years of experience as a loan officer and a realtor, has seen these, and he's going to take us into a deep dive into it. So go ahead, Jose.
Good evening, everybody. Thank you for joining us for today's training on our FHA 203K renovation loan. Amazing tool in this environment that we have right now more than ever. What am I talking about? Well, I'm talking about a tight inventory that we have, right? Limited inventory. We have people looking for homes that haven't found a home. Maybe they already own a home. And maybe they could just renovate that home instead of having to buy a new home. So a lot of different things to consider with the FHA 203K. But the main thing, it is a great tool for both real estate agents to be able to assist their buyers, for example, with properties. What am I talking about? Well, let's say we're looking at a property that has some condition-related issues that would normally make that property a cash-only purchase, right? HUD foreclosures, bank foreclosures, just vandalized homes in general. That's like a fixed flip buyer only or cash buyer only. Well, with your FHA 203K loan, you, the buyer, can purchase a home, and you, the realtor, can sell the home as well, right? Additional options, because aren't that many cash buyers around to buy those kind of properties. But great deal with the 203K. Now, for example, also you own a home and you're only considering moving or selling the home because you'd like a nicer kitchen, nicer bathrooms, new windows, new roofs, whatever it may be. You want your dream home. Well, if you already own your home, you can turn your home into your dream home with the FHA 203K renovation loan as a rate and term refi, and renovate and add new kitchen appliances, new bathrooms, impact windows, new roof, whatever it is that you may need, because we have the FHA Streamline option, which goes up to $35,000 in repairs, and then we have the standard option, which is just limited to the value of the property, right? So let me go ahead and share the presentation with you today. So here we are going to go over how to structure that FHA 203K loan. Now, wanted to touch a little bit on what Kyle mentioned at the beginning here. He mentioned that he didn't have it was a positive experience because his house was renovated. The house ended up with renovated kitchen, appliances, new flooring, exterior, interior paint, bathrooms, everything was redone on the home. But he had a run-in with an unscrupulous contractor. Wasn't really the program's fault, wasn't Kyle's fault. It was the contractor that just wasn't up to par. with what they had to do, and just did some typical things that some contractors may do, spread themselves out too thin, and then not respond to what was needed to be done. And whenever you go beyond the scope of the program in time, it does complicate matters, because FHA loans need to close within 6 months. The 203K renovation, should I say, the loan closes, but the renovation needs to be completed within 6 months, or else you're going to have an issue. So, what are we talking about with an FHA 203K loan? Well, we already touched on it. It's a renovation loan, but I guess technically it is a full-term mortgage, right, as opposed to a short-term bridge loan, which is what those fixed flip renovation loans are. They're not full-term loans. So the 203K is a full-term first mortgage that allows including renovation costs along with the purchase or rate and term refinance cost of the property. So you can use it for a purchase, like I was mentioning earlier, property with issues, or you can use it for a rate and term refinance, because they do not consider the renovation components cash out, because you're putting it into your property. So we have two different types of 203K renovation loans. We have our streamline option, which is $35,000 max renovations. And then we have the standard option. Now, besides there being a difference in the amount, right? $35,000 for the streamline, no limit for the standard. The streamline option, they call it streamline because, this is important now, you do not have to use a HUD consultant. What is a HUD consultant besides an additional expense? It's not really the expense we're worried about, because you're looking at anywhere from $400 to $600, $700, depending on the scope of the work. That's how they charge, because then they got a review. The issue with the HUD consultant is, let's say you have the scope of the work already set up, right? And now the HUD consultant goes in, and they're going to go in with their pad, and they're going to basically wipe the property down with a white glove, and pick up any additional items that were not noted on the scope of your work, meaning on the estimate, the work that's being completed on the property. Why is that an issue? Well, let's say you were doing a streamline refi at $35,000, and you took it to the max with your streamline renovations, and now the HUD consultant comes in and says, Jose, I'm sorry, but you have some items here that need to be addressed, right? Because they're going to go through the house for livability items. They're not really going to be looking at items like the color, the quality of your paint. They're going to be looking at livability items. So if there's any electrical things that are safety related that need to be redone that you may not have noticed, maybe you were just looking at cosmetic things, right? But they go and they look at your panel and say, hey, by the way, your panel is a Sylvania panel that has fire hazards. So I'm sorry, we cannot let you do this renovation without updating the panel, your electrical panel. So wow, now you're looking at $1,500 to $2,500 to $3,500 additional cost, because you got to update your panel. And now your $35,000 renovation is no longer a streamlined renovation. Well, if the HUD consultant came in, it wasn't a streamlined to begin with, right? But now you're adding $2,500 or $3,500 to the cost of your work. What if that takes you above and beyond where you could be qualification wise, DTI, maybe now is too much renovation for the value, which I'm going to get to that part in a minute here. I'll cover how we set that, but different things to consider. So, note if you need more than $35,000, then you're going to have to employ a HUD consultant as part of the deal. If you don't need more than $35,000, make sure that your loan is set up like a streamlined FHA. So I already mentioned the 203K is not a fixed flip loan, and I also mentioned that it's a great option for purchasing properties with condition-related issues that would not normally allow regular financing. We talked about the vandalized properties, properties missing air conditioning, and some wiring was ripped out. You cannot finance that with a regular loan. So unless you can't even close on it. You can't say, let's put the money in escrow and let me close. No, they will not let you close on it. It's going to be a subject to appraisal. Repairs are going to have to be completed. 1004D reinspection ordered, additional expense also to the borrower, right? So note of the great benefits of the 203K in that respect. Opens up another sector of the market for our buyers looking for properties or looking to keep their current property. So who qualifies for an FHA 203K loan? Well, it's a pretty standard loan. It's an FHA loan, primary residence only. U.S. citizen, permanent resident alien, non-permanent resident alien with U.S. credit. What am I talking about when I mean a non-permanent resident alien? I'm not talking about an I-10 borrower who does not have legal status in the U.S., nor do they have legal working status in the U.S. I'm talking about a non-permanent resident alien, which is a borrower here in the U.S. Legally working. They're going to have either a certain type of visa. They're going to have an employment authorization card, an EAD card from immigration, which allows them to legally work in the U.S. So as long as they have U.S.-based credit as well, they can finance a home here. Another example, for example, somebody with an H-1B1 visa, that's the visa for specialists. So companies can hire these specialists if they can't get enough of them here. Happens a lot, for example, with engineers, software engineers. Good example. Can't get enough of them here, so you can, solicit, quote unquote, import them, provide them their legal status while they are an employee of your company with that H-1B visa. So that's a non-permanent resident alien. So as long as they have the U.S.-based credit and legal work status, they can do the FHA 203K loan. No entity vesting allowed, obviously, because this is not an investment property. This is primary residence only. Now, real important here also to note on these 203K loans, it cannot be a self-build. So if you're a contractor and thinking, hey, I'm going to really help myself out here because I'm going to have them pay me for building my home. Nope, sorry, you cannot do that. You cannot be the contractor on your home, and the contractor cannot be related to you, right? Can't be any funny business going on. Now, the 203K does tend to have a 580 credit score. Now, again, it's a FHA product. So you look out for overlays when you are sizing up your deal. Remember, there's the FHA guidelines, then there are the overlays. But typically, you're going to find the minimum credit score is 580 for the 203K loan. Now, I mentioned about LTV, on a purchase and on a rate and term finance. Now, it's really important to note, on a purchase, the LTV is based on the lesser of purchase price plus renovations, or 110% of the as completed value. Now, FHA uses as completed value instead of after repaired value, which we tend to use when it's like renovation type properties. But so it's the lesser of purchase price plus renovations, or 110% of the as completed value, lesser of the two. So if this is a property that's being over improved with the renovations, you may have an issue, right? Because if the market does not support it, they're going to tell you, okay, you have an as completed value. They're going to give you 110% of that just to make, give you a little bit of extra cushion. But then it's going to be the lesser of, one or the other, purchase price plus renovations, or 110% of the as completed value. We usually don't tend to have a problem with these, but if the people go crazy with the renovations, that's where you may have a problem. And then for a rate and term refi, because they do not allow cash out refis on the 203K, the LTV is determined by using the existing debt plus the cost of renovation, or the adjusted as is value when the existing debt plus cost of the renovation does not exceed the after improved value, appraised value of the property. So a little bit tricky there, but they do give you a couple of different options there. One option if you owe a lot, another option if you don't really owe a lot, low existing debt and low renovation. But if you have high existing debt, high renovation, then not an issue, but is an issue if it exceeds the after improved value, appraised value as they call it, of the property. So let's go over some eligible property types and some important transaction details. A couple I already touched on. So eligible property types are your typical 1 to 4 unit property. Manufactured housing. Now there are some restrictions on the manufactured housing, so you do have to look into that. They're not going to let you go as spend as much on your renovations on a manufactured home as on a regular site-built homes. FHA approved condos. Obviously, you're only going to do the interior of the condo. Existing structure only. That's real important. And renovation of an existing ADU. You cannot add an ADU, and you cannot add square footage, because then you'd be adding foundation, which is not allowed. The standard option has a minimum $5,000 renovation amount, is really what that should say, and requires the use of a consultant, and the Streamline does not require. We mentioned the $35,000 amount. No cash back on refi, so no cash out refi. Now, you can use the 203K to correct health, safety, or security issues. The property must be an existing property that has been completed for at least 1 year prior to the case number assignment. That's pretty important, right? I mean, I don't know too many people that have a 8-month-old property and are already kind of refinanced with a renovation loan or stuff like that. But, I guess that could be something that would be an issue if you're looking to purchase a new construction. You can't purchase a new construction with a 203K loan just because you want to add stuff to the home. That's the part about must be an existing property that has been completed for at least 1 year prior to the case number assignment. And then really important to note here, raising or demolition of an existing structure down to the foundation is not permitted. That's not what this program is for. That's too heavy of a rehab. So what are some important points to consider here? Notice my first bullet point there, right? The MLO needs to complete training to be able to originate these loans, right? And I'm not just talking about our internal training company-wide. I'm talking about wherever this loan is going to be submitting, the originating loan officer for that loan has to complete training. So this loan, you have multiple components, right? So you have the borrower's credit and income, which will need to be approved by underwriting. Then you also have to ensure that the borrower already has a contractor familiar with 203K loans, as the contractor will also need to be approved. So your borrower's credit and income needs to be approved. The contractor needs to be approved. And then the contractor will need to provide detailed estimate, which will need to be approved by the renovation department. So borrower's credit and income needs to be approved. Contractor individually needs to be approved. And the renovation on the property needs to be approved. So The contractor, like I mentioned in the beginning, is an important, probably the most important component of this transaction, because not only do they have to individually be approved, but then the renovation has to be approved. And in order for the renovation to be approved, right, the contractor's references and track record will need to be provided and reviewed and be acceptable. The contractor is going to have liability and workman's comp insurance to minimum levels that are going to be required. The contractor is going to have trade credit. Why is that? Because the contractor cannot ask in these 203K loans for the borrower to provide a dime up front. You can't say, okay, borrower, give me 30% up front, write me a check, or write me a check for 50%. A lot of these renovators like to, ask the homeowner, the renovation contractor, should I say, like to ask the homeowner for 50% up front to, cover the startup of the cost. And then they get the other 50% once the renovation is completed. Well, that can't happen here. Now, you can arrange for a draw at closing for certain items, maybe certain stuff that may have already been completed, hard costs, some of the soft costs could have already been completed. But let me get to that now when I get to my bullet points. So references and track record, trade credit, and then I was mentioning itemization of soft costs and hard costs. What do we mean by that? Well, soft costs are like permit costs, architecture, soil compaction tests, permit runner, right? A lot of different upfront expenses that are not actual physical labor. Those are considered your soft costs. And then your hard costs are your actual costs of the renovation, right? The labor, the paint, the contractor overhead, right? Those are materials. Those are our hard costs. And you have a contingency reserve that's going to have to be factored into the mix. That's not going to be possible to factor out until you have that nice detailed estimate from the contractor. So again, a lot of this goes back to the contractor. If the contractor wants to give you an estimate written on a napkin, it's not going to work, or on like a one-page little estimate on their pad. That's not going to work. We're talking, they got to break it down, like, cost of labor, cost of material, contractor overhead. This is line item to the T for these estimates. And then once you have the full amount, then you can calculate your contingency reserve, which has to be anywhere from 10 to 20% of the total renovation amount. Now, if, for example, you have a property that the utilities are off, or it has or mold damage, that property is going to be a minimum 15% off the bat. And then depending on the extent, that's why it says they're anywhere from 10 to 20%. 10 is the standard for property regular condition. But as you get things like no utilities or additional damage, the contingency reserve could go as high as 20%. So again, I know probably the most important question that you would want to ask your borrower when you're interviewing them about the 203K loan, besides talking to them about their credit and their income and all that kind of stuff, you want to find out, do you have a contractor already selected? Okay, great. Has your contractor provided you already a detailed estimate of the repair? Now, if it's a rate and term refinance 203K, they may have already started that process. But if it's a purchase, which is now what makes it even trickier, if you're purchasing the home with a 203K loan, before you can close, we're not even talking about doing renovation. Before you can close on the loan, all of these steps have to happen. So if you're a contractor, if you don't have a contractor yet, then you already have a delay, and you're under contract for a 203K purchase. You're way behind if you don't have a contractor. You need the contractor, and a good contractor that knows that the 203K is going to need that super detailed estimate, right? And is going to need all of these items from the contractor. So it's a contractor that's ready to play ball. If you interview the contractor or, tell the buyer what they need, they interview the contractor is not willing to play ball on some of these points and don't use that contractor, your loan's not going to be able to close. I mean, I've had nightmares on a 203K loan where I have basically had to get the contractor's estimate, get the form, and rewrite that whole estimate, breaking everything down, calling the contractor, and because they just didn't want to do it. It was like a $60,000, $50,000 renovation, or no, not even that much, $30,000 renovation. They didn't want to do it, so I had to do it. I wanted to close the deal, so I had to help out and roll up my sleeves and do all that extra work. So be aware, make sure that you communicate this clearly to the borrower, so that you don't get stuck now with a purchase deal that can't close because your contractor is not efficient, doesn't want to, provide the needed documentation. So, and lastly here, I want to be able to cover, because this is probably one of the, as important as finding out if your borrower has a contractor, is making sure that the expectations that your borrower has about what can be done are accurate, right? You don't want to lead them on to believe that they can build a pool, which you cannot, right? Because notice there, pool repairs greater than 1,500 are ineligible, right? You don't want them to think that they can add an ADU, very popular, right? Which they cannot. Says it right there. You cannot add freestanding ADUs. But what you can also do, what you can also not do, is improvements that result in commercial use. Now, I'm not going to say an ADU is commercial use, but that's probably why they don't want you to add an ADU, because of that reason. You can add, you can't add additional dwelling units either. So, ineligible repairs, I mentioned a little bit earlier, foundation up construction. That's why you can't raise a property all the way down to the foundation and build like a new home. Definitely, you cannot add living space unless it's already like converting a garage, because you can't add foundation and then have foundation of construction. You're gonna have it. You cannot have any improvements or changes that are not approved prior to the start of the work. So once the work starts, that's it. You're gonna have some change orders, as is the case, because something wasn't taken into consideration, like you opened it up and oh my god, you need a couple of whatever, termites ate up the studs. I need 4 studs. Okay. You cannot. So it mentions there materials or work performed prior to the first draw. You can't get paid for that. So the first draw is going to be set on what they approve. So if you already had, I already spent the money on this. Hey, I'm sorry, we didn't approve it. Another important point, really important here, probably more so for the rate and term type thing. You may have started working on the home with your own money. You got 30% of the project done, your renovation done. You ran out of money. Now you're like, oh, heck, I need money. Let's do an FHA 203K so I can get my renovation funds to finish. But completion of an already underway project is an ineligible renovation. Not going to happen. I mentioned already improvements that result in commercial use, like probably more like adding a little mixed use to your property. Commercial use, you get the idea of professional office, retail, anything where you're going to be adding workspace. Changes to the number of the dwelling units is not possible. So you can't change that 1 unit property into a 2 unit property. Not going to happen. Oil tanks, reserves, oil tanks repairs or replacement. Now, why would they put that? I'm not really sure. My house used to have a heating oil tank. I used to have a furnace. I don't know why. I live in Florida. I guess it used to be a little bit colder out here where I live, but maybe it's for environmental reasons that they don't want you to add oil tanks or repair oil tanks. Construction of outbuildings. Now, the exception to that would be a detached garage if detached garages are popular in your area, common in your area. So if you're like a semi-agriculture kind of area and you need a detached for whatever garage, could be possible, but an outbuilding normally is an ineligible repair or renovation. I mentioned already freestanding ADUs. I know a lot of people have whet their appetite thinking they could do that. No, cannot. Repairs that cannot be completed in 6 months are also not eligible. And I mentioned pool repairs greater than $1,500. So I mentioned a lot of the theory here, a lot of the processes. We don't really have to talk a lot about the numbers because it's basically it's an FHA loan. You all know how FHA loans work, right? 3.5% down payment, 96.5% LTV. I mentioned that on the eligible borrowers slide. So the main thing to note here as loan consultants is how to properly frame the whole transaction so your borrower does not have unrealistic expectations on what will be possible, so that you can give them the proper guidance, setting everything up, putting everything together, making sure they have that contractor in place that can play ball with an FHA 203K loan, because that has been the biggest stumbling block on these. That's why, unfortunately, Kyle was left with a sour taste in his mouth with an FHA 203K loan, because his contractor just, messed up so much on his deal, frustrated him so much that he is scared to do another one. But I can trust you folks. That's because Kyle was not using the mortgage calculator to do his loan, right?
Yeah, that was my first house I ever bought.
Yeah. We weren't informed yet, and he hadn't studied this whole. His loan consultant, unfortunately, did not give him this kind of guidance. But with everyone who's on this call, totally different, right? Our team knows how to handle these deals, and our borrowers, hopefully we're empowering them as well, because if your borrower is empowered, transaction is going to be a lot smoother.
All right. Surprisingly, I don't see any questions here.
We did have a comment come in. Someone called you out, Jose, on the 203K limited, not streamlined.
Oh, limited. Okay.
Limited. The streamlines the rate and term. Remember? So
okay. Well, then
they changed the nomenclature.
We got to then deal with the guidelines that I was looking at, because I was looking at in lender guidelines, and they were actually referring to it as streamlined, actually. So maybe they're not correct. I don't know. Maybe I should call them out too.
Well, they changed the name, so maybe.
Yeah, because that could be it. Because I was actually looking at some guidelines that had that nomenclature on there.
All right. Well, I don't see any questions, so let's go ahead and wrap it up here. Remember, we do this at 7 p.m. Eastern on Tuesdays and Wednesdays, so we'll have a new topic for you tomorrow. We appreciate everybody tuning in. We'll see you tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Have a great night, everybody.